Hi, I hope you had a chance to look at what I did in the last 15 to 20 minutes because I think what's important about that is if I could spend hours on it, literally, it reflects a thinking process and just making things exactly precise to be able to run this stuff. I can do it in the video, but I would encourage you, and I'll warn you whenever some stuff is easy or not. Remember I told you earlier a joke that if you don't know how to divide, learn how to pretty quickly. Here I would pause and remember though with one thing, one warning, is that don't spend too much time on theory. Theory is only useful in business if it's practical. And this stuff is so practically useful to do stuff I'll come to in a second. So before we jump into an example, let me just wrap up what we thought about another way. When you think of any stock, any company's equity, and for the time being assume no debt, you can think of it using this simple formula. P0 equals EPS over R plus PVGO. Remember one, this is a conceptual way. It's not, I'll tell you what it means in a second. So quickly, definition. What is EPS? As I said, everything is per share like the price is per share. You don't have the whole company trading. Of course, there are prices these days of companies where your mind starts getting boggled about how the heck is anybody going to buy one of those shares. Anyway, where EPS is the cash flow per share and PVGO is the present value of growth opportunities. So it has to do with whatever we did right now. So let me ask you this. What is the price of a stock? The price of a stock is the present value of dividends. Just conceptually, right? Now, there are two formulas that come about. One is when you have no growth, and one you have growth. Right? Pretty straightforward. And we know where growth is coming from, how is it generated, we spent some time on it. So let me ask you, which company would have the first piece applicable to? We just did examples. Which of the two examples would have the first piece applicable? Green utility. So green utility, look what I have done. I'm going to assume green utilities PVGO is by default, by definition 0. And the reason is it's not putting anything back. So if you're not putting anything back, this formula becomes relevant. Why? Because if there's no growth, what is the price of your stock? Dividend over R. But remember, if you're not putting anything back, this is also EPS over R. So the first piece of this formula is telling you what would you look like. That part of a company you can think of which had nothing to do with future growth. Can you think of companies who are not going to grow at all? Sure you can. But what I'm saying is you can think of every company as having two pieces. One without growth and one with growth. Right? Remember, everything is incremental. Right? So if it is without any growth, you're thinking of the company, and many companies are just that, but you can think of any company in that way, what would you think of the formula? Div 1 over R. But because dividend is exactly equal to earnings per share, why? Earnings per share is being paid out totally as dividends because you're not planning to grow, right? But which comes first? Remember the engine of growth. What comes first? Earnings per share or dividend? Earnings per share. Never put dividend before earnings per share because you're again doing MC Hammer. Can't touch this. Cash flows, earnings per share come from whom? Your assets. And dividends are payments to your liabilities or the way you've financed it. Okay? So this is pretty straightforward. So this is the formula of no growth. What is the formula of growth? What happens with growth? With growth, you have your existing assets, but then you have something more. And that's called future growth opportunities. And what was the formula for that? P naught is equal to div 1 over R minus G. Right? So how do you figure out PVGO? And this is the point of this exercise. So suppose I want to know whether there is PVGO or not. The first thing I have to recognize is for PVGO to happen, you have to be prepared to reinvest in the firm. But to figure out your PVGO, you can do this simple exercise. Think of the firm without any growth and think of the firm with growth. The difference between the two is called PVGO. Right? Make sense? Because PVGO, if it's 0, what is G in the formula here? If you're not planning to grow, G is 0. You're not reinvesting, and the two formulas collapse. So keep this big picture. I love this. One final question for you. Think about it. Suppose I asked you in the 70s, 60s, and so on, you looked at the whole stock market of the world. What part of it would belong to the first part? That is, the value of your existing assets with organic growth but not planned growth, versus what did the future opportunities look like relative to after the internet came through and dot-coms emerged and after the fallout, right? You don't have to necessarily think of the peak of it. Well, things have flipped for many companies. It used to be that your business as usual was generating most of your value, but now what has happened? The growth opportunities reflect value, right? So that's what a major breakthrough like the internet does for society, okay? Technological innovations. Anyway, so I'm going to now start doing examples, and I'm going to go a little bit simple, slow, and this is a very good opportunity for you to practice. Suppose you know this about Microsoft Inc. Microsoft Inc. is expected to earn 10% on its existing assets. Questions, what does that 10% mean? Is it the little r, or is it the IRR of its existing assets? And remember, if some number is reflected as belonging to your assets, it has to be IRR, ROI, return on your investment. Has $60 capital per share. So what have I done? I have taken Microsoft, and how did I get $60 capital per share? Remember, you're starting off, you have, say, $1 million worth of investment, right? And you divide that by a number of shares, that's what the 60 is. So let's assume for simplicity, you have $6,000 of investment and 100 shares. That 60 is just a function of that division. And why are we doing this? Because remember, everything in stocks is per share. The market capitalization rate is 12%. And please, any calculation you do is meaningless unless you know what the heck you're doing, right? And because, plus all the numbers are wrong, right? So remember that. What does market capitalization rate mean? And remember, this is another word that I'm now beginning comfortable to throw at you. This guy is also what we usually call the little r. As soon as the word market is used, you know that it is something that is being used to evaluate you. Okay? So where did I get this? And by the way, the rest of this class, almost, at least the next 2 weeks, are all about this, because we haven't touched risk and return as yet. Where is it coming from? Similar businesses. I'll let you figure out who's doing similar business to Microsoft. The company is not planning to grow. What should Microsoft Inc.'s shares trade at? Let's take a 5 minutes break. Do this problem. Stare at all the concept that I gave you earlier on. The good news here is there is no growth. So tell me what is the value of this stock, and try to spend some time, and we'll come back and do it together.